So welcome everybody to this event on dual class shares, which is jointly hosted by the Edinburgh Law School Centre for Commercial Law, the School of Law at King's College London, and the Centre for Business Research at the University of Cambridge. My name is Christie. I'm on the faculty at Edinburgh Law School, and I'm also a research associate at the Centre for Business Research in Cambridge. And I'm really delighted to be sharing this event where we have an absolutely brilliant lineup of speakers from across academia, industry, and practice. I won't spend too much time introducing the topic at hand, as I'm super keen to ensure we have enough time to hear from all of our expert speakers and have a really engaging, interactive discussion after the formal presentations. So just very briefly, I'd like to note that we're really glad to have representatives here who advised both the Kalifa FinTech review and the UK listing review produced by Lord Hill. So as I'm sure many of you know, both of these reviews proposed amendments to the UK listing rules in order to improve the UK's competitiveness as an attractive location for IPOs. And we'll be focusing primarily on the UK in today's event, although the topic of dual class shares is one of global interest, especially with regard to issues of regulatory competition. So I'm also really pleased that we have a very global audience here today with participants from all over the world. And the last few months have certainly been a very eventful time in relation to this topic of dual class shares. So shortly after the publication of Lord Hill's listing review in March this year, we of course saw the Deliveroo IPO, which some journalists have described as the worst IPO in London's history. and many well-known institutional investors stated they wouldn't invest in the company due to its dual class share structure, among other issues. And at present, Deliveroo has a standard listing where there's no restriction on companies listing with a dual class share structure, but the Hill review reforms proposed to enable such companies to become premium listed, subject to a number of safeguards. And this matters for many reasons, but particularly because of the ever-growing landscape of passive index investment funds tracking premium listed companies that are constituents of indices like the FTSE 100 and the FTSE 250. So standard listed companies lose out on those investments. In addition to our representatives who have advised on the Kalifa and Hill reviews, we're extremely privileged to have eminent experts from academia, legal practice, and the investor community here with us this evening to discuss this very topical and controversial issue. So I'm sure we'll hear a range of different perspectives, which we hope will also lead to a fascinating and engaging discussion after the presentations. In terms of the structure of the event, as Ewan just mentioned, during the first hour, we'll hear from each of our speakers in turn, who will outline their initial thoughts for approximately 8 minutes each. And then in the second hour, we're going to open it up to the audience for Q&A. In terms of asking questions after the speakers have concluded their presentations, you're all very welcome to raise your hands on Zoom using the raise hand feature, and then you can ask your questions or make your comments live. Or if you prefer, you can send us your written questions in the chat feature, either during the presentations or afterwards, and hopefully we can get to all those written questions as well. In terms of cameras, it's always nice to see everyone's lovely faces, so please do feel free to switch on your camera if you're able to do so. And before I hand things over to our speakers, I'd like to thank Ewan McGaughey for all his work in organizing this event this evening. And I'd also like to thank Ian McGee in the events, the Edinburgh Law School events team for all his help with the administrative aspects as well. I should say that two of our speakers may have to drop off the Zoom call a little bit early, so before the 7 p.m. sort of official close. So I'd like to extend my thanks in advance of the presentations to all of the speakers who've kindly accepted our invitation to speak tonight. Okay, without further ado, I'd like to introduce our first speaker, Anne Glover. So Anne is the chief executive and co-founder of Amadeus Capital Partners, which is a venture capital firm that invests in European high technology companies. Anne has been an active venture capitalist for over 30 years. She's the former chair of the British Private Equity and Venture Capital Association and is a non-executive director of the Court of the Bank of England. And she was also awarded a CBE for services to business. And we're really excited to hear Anne's perspective on this issue today, as she was a key figure in the Kalifa review on UK fintech. And in that role, she led research and recommendations for the chapter on investment. Anne, I'll hand it over to you. Thank you. Oh, Anne, I think you're muted.
I muted myself, so I didn't cut across you. Can you hear me now?
Yes, we can hear you. Thanks.
Thank you. Yes, I'm honored to be here. Thank you very much for giving me this opportunity. Obviously, as a venture capitalist, I normally work with very early stage companies. So you might ask, why do I care about something as far away as listing and dual class shares? And the answer is that all of the success of growth companies comes from the way in which an ecosystem works. And an ecosystem works by enabling entrepreneurs of various flavors, whether scientific or fintech, to create entities that ultimately grow and succeed within that ecosystem. And what we have in the UK is a disconnect between the innovation agenda and capital markets. And the disconnect happens in both public markets and in private markets, where the growth capital that allows an innovative company to grow and mature to the stage that it merits being a listed company is largely supplied, if at all, by foreign investors. And the foreign investors make a very good return from this growth capital, whether they be Canadian, Australian, or US pension funds, or indeed even in listed securities from elsewhere. The conservative nature of our latest stage asset management community means that they do not naturally reach down into private markets or indeed into more junior listed markets to invest, with Baillie Gifford being a notable exception. Whereas Wellington, Fidelity, etc., fully understand the merits of being part of the growth ladder. So why does this matter to me and to the UK economy? Why I care about it is that if we lose our listings to other markets from companies that start here, we may, and we often do, give great returns to our investors, but the center of gravity of both leadership and in some cases R&D moves elsewhere. And this happens naturally when the capital that is supporting the growth tends to come from overseas, who know the degree in which the road to NASDAQ is so well trodden. So some shocking statistics are over just under 4,000 listings worldwide in the last 5 years. 39% were in the US, NASDAQ and NYSE, and 4.5% were in London. Now, within the fintech community, which is the area that I was looking at for the Kalifa review, the revenues that our fintech companies generate is closer to 8.5% of total global. So we are actually, in terms of our economic input, more significant, and we are in danger of losing it unless we create an environment where these scale companies feel comfortable being domiciled here for the long term. And it's really important that we have these champions that end up being a place where leadership can grow, where talent can be nurtured, where people can spin out from and do it all over again. And so you need the full chain from startup right through to listing. And I don't mean just listing, I mean the creation of a decacorn and a FTSE 100 community that is followed and then supported by asset managers and analysts, the like, in London. So everyone was interested in this. Then the question became, why is it not happening? I've explained one reason, which is that the growth capital is coming from elsewhere, and the bias of the boards at that time will tend to argue to go to usually a US market, but not always. But the second reason is a series of obstacles in the listing space. And I'm here to talk about dual class shares specifically, but it's not the only one. The free float was clearly a problem, because if you have a very successful company that's reached $1 billion in value or more, which is probably what it needs to be in order to be considered viable for a proper listing, even in London today, the listing of a 25% block means that you have to find 25% selling shareholders, and that's actually pretty hard. And particularly if it turns out that founders want to stay in and existing investors may or may not want to liquidate immediately upon IPO, but would rather hold for 2 or 3 years as a crossover fund, like a Baillie Gifford or a Wellington or a Fidelity. So reducing the free float matters, as long as it is of a size that is liquid enough for asset managers to achieve the liquidity that they expect from a public listing. So that was a key recommendation from the point of view of the investors, primarily from the point of view of investors. But when you actually talked to the entrepreneurs themselves, you found that while that mattered, in fact, this issue of dual class shares became really front and central in their thinking. And it was not born of the desire to sort of control something forever, a la Mark Zuckerberg. It was born of a genuine fear that they had seen the London market be a place where, because of macroeconomic volatility and because it takes a while for a young company to mature into its own communication pattern, that they would be vulnerable to immediate short-term takeover if there was a volatility in the share price that did not represent the long-term value potential of a company. And and with a bump in the road, then investors might just take the opportunity. So we talked among the entrepreneurial community, and it became apparent that, yes, of course, the standard market was an option, and the Hut Group was successful and Deliveroo was not successful. Both of them chose the standard market route because that enabled them to issue some kind of dual class share. I do not think that the Deliveroo debacle had much to do with dual class shares at all. I think it had a lot to do with employment practices. That's a personal opinion. But it is very clear that the Hut Group was hugely successful. So it is investor specific. But what became apparent is that there were a number of compromises that entrepreneurs were willing to live with. For example, that any type of dual class share could be time limited. Do not know what time is appropriate, but that this was a sort of maturing phase of a new company on a listed exchange. So we're not asking for eternity. They were asking for a period of time in which they could, in their own mind, protect their investment. The second was that there was not a desire for it to be widely distributed necessarily. So it wasn't dual class shares. It was actually more likely to be a golden share, where there is vested in one genuine entrepreneur who's probably founded the company in the first place, who therefore would act on behalf of not just frankly, the management team, but possibly also the early investors who still had not achieved liquidity. And the UK has this golden share concept, and it has worked well. So we were not talking about creating a class of have and have not citizens, but a mechanism by which, in effect, sort of a rapacious takeover during a volatile moment in time would be prevented by through this mechanism. So I became convinced that this was a good idea, and that it didn't in any way in the long run violate the idea that capital markets are good at establishing price discovery and liquidity, which we all need in mature companies. But that the mechanism of a guillotine, where you go from private to public and have all the vagaries of public scrutiny all at once, was probably better mediated by some intermediate set of steps. So we put forward a recommendation, which was frankly that Lord Hill Review take over looking at this, and the FCA also. And it was supported lastly by a piece of work done by a well-known venture capital group in Silicon Valley called Andreessen Horowitz, where they basically demonstrated that founder-run public companies where there is some control among the founders had tended to outperform manager for hire public companies who did not necessarily understand the full vision and the full potential. So we're not saying it needs to be for everyone. It's for a certain category of company that is perhaps unusual in having been founder run from the beginning, but that the option is important, and that it's available on the standard market is not sufficient. These are ambitious guys who want to be in the best market with the best access to investors, so that while the standard market may seem like a place for it to be possible, it's actually not what the best entrepreneurs want. If they want it, they want to be on the premium market. And that really is the argument from an entrepreneur's perspective for a dual class share. Thank you.
Thank you, Anne. That was super interesting to hear your perspectives from talking to various constituents in relation to the Kalifa review. I'll swiftly move on to our next speaker. I'd like to introduce Professor Luca Enriques. Luca is a professor of corporate law at the University of Oxford and a fellow of Jesus College. He is also a research fellow and board member at ECGI, the European Corporate Governance Institute, and a fellow academic member of the European Banking Institute, where he co-chairs its FinTech task force. Luca has published extensively in the fields of company law, corporate governance, and financial regulation, and he's also one of the founding academic editors of the Oxford Business Law blog, where he recently published an insightful blog post on this very topic on dual class shares and the Hill Review. So we're really delighted to welcome Luca to this event. Over to you, Luca.
Thank you, Anna, for the introduction, and thank you and Ewan for having me today. I will, in my 8 minutes, I'll try to make 2 points. I don't know whether it will be enough in terms of time, but let me start immediately. So I would like first to make a general point about why dual class shares may be a good thing in today's markets environment, because we know that there are many well-known rationales to allow for dual class share companies. The main one, which was already hinted at by Anne, is the idea that the market may misjudge companies, especially new innovative ones. They may impose their own standardized views on what the strategies should be, what kind of innovation the company should focus on. whereas founders usually have their own idiosyncratic vision that they want to pursue independently of pressures from the market. But I would like to focus on an additional rationale, which is one, again, just which is more recent in terms of what's going on. That is the idea that nowadays we are in a market environment dominated by portfolio value maximizers, by institutional investors whose goal is to maximize the value of whole portfolios rather than the value of each individual company they invest in. And so at the same time, of course, we have other market players, namely founders and controlling shareholders or even managers when they have the right incentives that may want to maximize firm value if they can. And so the portfolio value maximizers are now dominating, especially in the US and in the UK. And this has good effects and bad, as we know. So for companies that produce huge externalities, may be good to have a dominance of portfolio value maximizers, because they will, to some degree, internalize the externalities of the individual companies at the portfolio level, and therefore may push companies to, for example, emit less greenhouse gases or pollute less. But for let's call it not systematically relevant companies, firm value maximization is important. First of all, because of a Haykian view of the benefits of competition, having decentralized decision-making in society is good for value creation. But secondly, also because we need companies to compete rather than collude, and with horizontal shareholdings so widespread now in the economy, thanks to the presence of large universal owners, there is a higher risk of collusion. And so dual class share structures can also be explained as an attempt by the founders of a company to signal to the market that their company will be run as a firm value maximizing company, instead of being influenced by the presence of institutional investors, which may be less keen on the disruptive innovation, but which may come from individual company and from the heightened competition that may come from that kind of prioritization of goals at the individual company level. So that is why, and this is something that I have been developing with Sandro Romano in a paper that is available on SSRN. Actually, we will spin this out and make it an independent paper. But so what is relevant here is that hence the signal that is sent to the market will be credible. On the one hand, if the founders will have a significant financial stake in the company, that's pretty obvious, but also if it is not time constrained, if there is no sunset there, because otherwise there is little credibility in this commitment. That is why a sunset is inconsistent with this rationale. It may be less inconsistent as unnoticed with the other rationale, which is to this issue of idiosyncratic vision against the standardized view of markets. this was my first point. I have, I think, another couple of minutes, but the other point is less conspicuous. Also, it's something that Anne's word made less relevant, because she said that a top-class founding entrepreneurs want to be in the best possible market, and so that's the rationale for going there, much less than what you read also in the Hill review as one important aspect, which is that if you are in the premium segment, you can be included in the FTSE Russell indexes, which is again something that in the literature is said to be relevant. The problem with this rationale for admitting companies with dual class shares in the premium market is that it may not achieve the goal of having companies admitted to included into indexing, because it's not enough to be a premium listed in theory, at least in order to be within an index. It's the FTSE Russell company which decides the criteria, decides on the criteria that apply in order to be admitted to an index. And it is well known that these companies, these index providers, make the decisions after listening carefully to the desiderata of their users. And the users are mainly the US and UK institutional investors, which we know to be very much averse to having these companies, dual class listed companies, in indexes. So basically, I don't think that the Hill review proposals will achieve much, so long as there is this aversion to dual class structure on the part of institutional investors. It will be interesting to see the dynamics play out there, because as you know, FTSE Russell is owned by the London Stock Exchange Group, which has its own interest in, of course, enticing these companies to list on the London Stock Exchange. But on the other hand, we also have a benchmark regulation which applies to index providers, which requires the index provider to be independent and to have a conflict of interest policy that should prevent the owners from affecting the decisions of the index provider. So that is all of my part. I have exhausted my 8 minutes. Thank you for your attention.
Thank you. Thanks so much, Luca. Our third speaker is Claire Keast-Butler, who is a partner in the London office of the American institutional law firm, the American international law firm Cooley LLP. So Cooley is particularly known for its technology and life sciences practices, as well as its experience with IPOs and venture capital financings. Claire's practice focuses on capital markets transactions. So she represents issuers, investment banks, and investors on IPOs and secondary offerings. And Claire has published various opinion pieces advocating for a rethink on the UK's restrictive rules on dual class shares. So we're really looking forward to hearing her thoughts on this issue.
Great, thanks Anna, and thanks Ewan. Thanks for having me here today. My name is Claire Keast-Butler. I'm a partner at Cooley, which is an international law firm focusing on capital markets and public companies. At Cooley, we regularly work with founders of disruptive companies, particularly in the technology sector, as well as the venture capital firms that back them. We are a Silicon Valley heritage firm, so we're very familiar with dual class structures, why pre-IPO shareholders want them, and some of the key considerations and issues surrounding them, taking it from what we see in the US and looking at the UK and Europe. We've been vocal in our support for dual class structures and regulatory reform to ease them in the UK. We've covered some of this already, but I thought just taking a minute to go back to basics and say, what is a dual class share structure? A traditional share structure for an English company certainly is 1 share, 1 vote. So each shareholder has 1 share for each vote that they share that they hold. A dual class structure involves 2 different classes of shares with differential voting rights. This would be put in place at or shortly before the time the company does an IPO. And what that means is that founders and potentially other pre-IPO shareholders are able to maintain voting control of the publicly listed company through holding shares with enhanced voting rights compared to the shares held by public shareholders. So for example, the most commonly seen dual class structure, certainly in the US, is the founders and the pre-IPO shareholders may have 10 votes per share, while the shares held by public shareholders have 1 vote per share. And typically the high vote shares will convert into low vote shares when they're sold. So you can't sell the high vote share in the high vote form. So control is held by the early holders that continue to hold the shares once the company goes public. Why do companies want dual class share structures? What do we see sort of on the ground talking to companies? I'd say Anne and Luca covered this excellently already. We do see this structure as being particularly attractive to rapidly growing companies, especially in the technology sector, where founders wish to retain voting control following an IPO. And they would argue that the traditional 1 share, 1 vote capital structure isn't appropriate for companies on their trajectory and at their growth stage. One key argument in favour of dual class structures is that they allow visionary founders to concentrate on the business's long-term strategy, growth and performance without having to focus unduly on short-term targets and being subject to shareholder activism while they're still in this high growth phase and when they've just joined the public markets. What's the legal position in the UK? As Anne said, dual class structures are possible as a matter of English company law. You can bake it into the share rights and the articles of association of the company and work out the mechanism for converting from high to low vote shares. However, as has been touched upon already, as things currently stand, a company with a dual class structure wouldn't be eligible for listing on the premium segment of the FCA's official list, as that requires a 1 share, 1 vote capital structure, although a company with a dual class structure could seek a listing on the standard segment of the official list. This may be known to everyone already, but I thought I'd just explain the difference again, as people have touched upon, between a premium and a standard listing. Both are a listing on the London Stock Exchange, on the main regulated market of the London Stock Exchange, but the premium segment is the highest segment with the highest eligibility requirements and continuing obligations, as well as eligibility for the FTSE 100 and the FTSE 250, as has already been mentioned, assuming that the other eligibility requirements for those indices are met. The standard listing segment has sort of lower eligibility and ongoing obligations. It's based on what was traditional EU minimum requirements under the EU directives. So the requirements both at listing and on an ongoing basis are significantly less onerous. What do we see in other jurisdictions? Dual class structures are permitted and are relatively common in the United States, especially for technology companies. High profile examples include Facebook, Google, LinkedIn, Zynga and Snap. Snap actually has a publicly listed class of shares that has no votes, which is at the extreme end. Since 2018, companies with dual class structures have been able to list on the Hong Kong Stock Exchange in certain circumstances and subject to certain requirements and restrictions. Following these rule changes, the company Alibaba dual listed in Hong Kong alongside its existing New York Stock Exchange listing, raising 88 billion Hong Kong dollars in late 2019. And Singapore also changed its rules in 2018 to allow for dual class structures. Closer to home, dual class structures are also possible in other European jurisdictions, including notably, I would say, Amsterdam, which is a market we increasingly see as a strong option for listing for European tech companies, and is often sort of up there when companies are considering where to list if they want to list in the UK or Europe. So what are we seeing in the market? There have been a number of high-profile IPOs recently that have employed different variants on the dual class structure, and again, these have been touched upon already. In the case of the Huck Group last autumn, the founder held a special share, which effectively allowed him to block a takeover offer for 3 years after the listing. Whereas in the case of the Deliveroo IPO in the spring, the founder held a separate class of high vote shares, which had 20 votes per share on all shareholder votes, as compared to 1 vote per share for the other class, but was time limited. As has already been mentioned, both the Hut Group and Deliveroo listed on the standard segment of the official list, as these structures would currently render them ineligible for a premium listing. And we are aware of other companies working towards a listing in London in the near future with other variants on this dual class share structure. We reviewed Lord Hill's listing review with interest, and I'm really looking forward to hearing Chris's insights on that shortly. The Lord Hill review recommended allowing companies with dual class share structures to list on the premium segment, but with certain conditions that would include a maximum duration of 5 years, a maximum weighted voting ratio of 20:1, requiring the holders to be the high vote shares to be directors of the company in order to maintain that high vote status. And also limiting the voting matters to ensuring the holders are able to continue as a director and being able to block a change of control of the company while the dual class share structure is in force, and really going to that core reason for having the dual class share structure, as Anne spoke about so eloquently earlier. And there are also limitations on transfer of the B class shares. We see this as a very welcome development, but it's worth noting that it still wouldn't allow a dual class structure on the premium segment in the form we would most typically see in the US. And there's 2 key parts to that. In particular, in the US, in the majority of cases, all of the pre-IPO shareholders hold the high vote shares. So not just the founders who'll be directors of the company, but all of the shareholders before the IPO have the opportunity to hold the high vote shares, and that wouldn't be available with these proposed changes. And then secondly, the weighted voting rights in the US would typically apply on all matters, not just relating to the holders continuing as directors of the company and being able to block a change of control. So companies that want a true US style dual class structure would still need to list on the standard segment rather than the premium segment, even if these changes are enacted. As Luca said, changing the rules is only part of the solution. We see this as a very welcome development, but part of a broader package of measures to make the UK a more attractive place for technology companies. And why does this matter? The capital markets are increasingly international, and UK and European companies have a choice of listing on a number of different exchanges. We see a lot of exciting UK and European companies in the disruptive technology sectors that are likely to be at the stage of looking at a potential IPO in the coming few years. And we would very much like to see we at Cooley would very much like to see London as well placed as it can be to be the listing venue of choice for these companies. I think that's about my 8 minutes, so I'll stop there, but thank you very much. And I look forward to hearing the other speakers.
Wonderful. Thanks so much, Claire. I'll move on to our 4th speaker, Chris Locke. Chris is a partner at Ernst & Young in London, where he leads the financial services transactions diligence team, which covers IPOs, public to private deals, debt and equity raises, acquisitions and divestments. Chris has worked for over 20 years in the financial services industry, and he worked closely with Lord Hill on the UK listing review. So we're really delighted to welcome him and hear his insights on this.
Thanks very much, Hannah, and good afternoon, everyone. So what I thought I'd do today is just quickly run through a little bit more about the context behind the Hill review and some of the thinking that went into it as we went through the process, and then sort of pick through some of the considerations when we thought about DCSS and where we got to on the recommendations there. So very much, as Anne has mentioned beforehand, there's been a strong drive from the government side to consider how we can boost the UK as a destination for IPOs and to optimise the capital raising process. There's also equal highlights within the terms of reference that Lord Hill got to be considering the UK's high reputation for listing standards, governance, shareholder rights and transparency. And I think that really filtered through into the clarity point that says, you know, this was not a review designed at what people sometimes term as the Singapore on Thames, the reduction in regulation across the UK. That was sort of met with terms of horror as we sort of worked through the process, where people sort of considered that and pushed that forwards for us. Very much thinking more around the refinement of the existing listing rules and evolution. It's very clear it's not a silver bullet for the market in the UK, but it starts to go some steps towards solving some of the challenges in the industry at this stage. And hopefully, as those recommendations come through and we go through the various consultations with Treasury, FCA, etc., we'll start to see some more traction on that going forward. So moving on to DCSS then. So this was probably a part of a package of considerations that came pretty much part and parcel with free float and the level of free float being offered. Claire, I think, has made reference, and Anne also, to level of voting rights and the terms on which you can do voting. So very much intertwined there, and also somewhat intertwined with track record requirements and the ask to demonstrate a history of performance in businesses before they get eligibility for the premium listing under Listing Rule 6. In terms of the actual dual class share structures, it's fair to say that absolutely got the biggest volume of feedback in terms of the request for evidence. So I think we got 65 responses back from the market, and there was reasonable reams on this, and very clearly there was a huge swath of considerations here, with some sides being absolutely pro the change and others absolutely anti the change. So there was a huge amount of effort to work through that, and that was followed on by a large number of roundtable exercises that were done to get people sort of more detailed responses to that and the reasoning behind it, and also really on some of the one-to-ones as well. So we were very clear that this is an area of tension in the markets between many of the interested parties. I think, as Luca mentioned, it was very clear that just for getting onto a premium listing doesn't necessarily make you eligible for index inclusion. And you think about the FTSE Russell, how they may adapt their eligibility requirements for that going forwards. I think actually, though, one of the bigger challenges about consideration of dual class share structures and the eligibility for a premium listing really is around the challenges we have in the UK market about how people view the standard segment versus the premium segment. And a lot of recurring challenges we really see is that no matter how good you are, if you're not on the premium segment, people say, but you're not on the premium segment. And it becomes a real dent and a real challenge for people to actually explain why you go for a standard listing rather than a premium segment. And actually, the fact that we've got that separation within the UK and the challenge of that split is actually one of the bigger drags out there. And I think actually the index inclusion becomes slightly secondary after that, in terms of actually, if you can demonstrate your highest levels of governance, demonstrate that you can get to that standard, excluding the share structure that we're debating now, actually that goes a huge way to helping people demonstrate that they've got a robust business that's suitable for investment going forwards. And funnily enough, considerations of the indices actually was thinking the other way, to say, well, actually, if we have a large volume in the longer term of very high performing businesses in the standard segment or on the premium segment that are currently excluded from indices, you might find indices changing their thinking about what is the right company to include in their index going forward. So we were very much seeing it actually coming the other way, to say that you might find that there's a lot of unhappy shareholders there that's saying, I've got a passive fund and I'm missing out on all the opportunities with these wider businesses because of that exclusion. So, two ways to go on that. And obviously that's a long way to go into the future, but something that was sort of front and center of mind as we went through these considerations. It was also very clear from us that, dual class share structures have a massive range in terms of just one golden share to, effective control of the businesses, and therefore you can't just take dual class share structures and say good or bad. You really have to look into the individual circumstances for businesses and think about what are those businesses trying to achieve with those structures versus where they are with their peers, where they are with the market, and where they are with the challenges on the governance side of things as well. Having gone through all of those considerations and the drive, it became sort of clear to the advisory panel that just a set of disclosures probably wasn't going to be enough to counter that consideration and the concerns more broadly from some of the parties, that sufficiently gave investors enough insight that they could make a decision without those protections. And hence, as Claire has mentioned beforehand, therefore the Hill review came up with a variety of guardrails as we put them in to help limit the extent of that dual class share structure within a premium segment. And that was really much about this refinement of regulation rather than the removal of regulation, to say where is an appropriate level that means you can get founders who have got huge challenges and concerns, and we listened to an awful lot of them as we went through that process, versus the challenges and concerns of the loss of some of that governance and challenge that side, and sort of tried to thread the needle a little bit on that to get to a point where we felt we had a balance between enabling that to remove some of those barriers for a lot of those, fast growth companies out in the market. As Anne mentioned, we've got a good growing percentage there, and we want to make sure we're limiting the barriers into the IPO market going forwards. So a very interesting process. 3 months. It was fairly fast and fairly high paced to get through that. And ultimately, now we look forward to seeing, consultation from the FCA in due course, and seeing where we get to. But undoubtedly, there will be continuing to have lively debates on the subject for many years to come. That's all I'll say for the moment.
Thanks so much, Chris. I'll move on to our fifth speaker. So our fifth speaker is Dionysia Katelouzou, Dr. Katelouzou. Dionysia is a senior lecturer in corporate law at King's College London and a research associate at the Centre for Business Research in Cambridge. Dionysia's research focuses on comparative and transnational corporate law and corporate governance, financial market regulation, and law and finance. Much of Dionysia's research looks at the role of institutional investors in corporate governance, and she also leads the ECGI-supported Global Shareholder Stewardship Research Group. Over to you, Dionysia.
Thank you so much, Anna, and thanks to Ewan for inviting me to contribute to this very lively debate. As the introduction by Anna probably showed, the perspective I'm going to bring to this debate is quite different from what we have already heard from the speakers. 5, 10, or maybe 15 years ago, I never could have imagined that a small activist hedge fund could have won board seats in one of the largest oil companies in the world a couple of days ago for the purpose of climate change. And there are many astonishing features about this victory of engine number 1 against ExxonMobil, but from the perspective of what we're discussing today, I think it is interesting to ask whether this stunning battle would have even been possible if ExxonMobil had a dual-class share structure. So this is the perspective I'd like to bring in within the next few minutes. And the question I'd like to ask is whether what we are asking from the institutional investors in the UK for years now, in terms of stewardship, is really compatible with the proposed regime on dual-class shares. It is well known that since 2010, the FSA is asking from institutional investors, and even actually before, to act as stewards of the companies they invest. The UK Stewardship Code 2010, which was revised in 2012, was designed to cure what was perceived to be the UK's primary problem, and that is rationally passive institutional investors in a country characterized by a dispersed ownership structure. In theory, this concept, this stewardship concept, makes sense in the UK, as institutional investors own majority of shares in listed companies and therefore collectively have the right to steward the companies, if of course they have the incentive to do so, and that's a separate debate. But even though in theory the concept is sound, in practice, after a decade, the consensus is that the old code, the 2012 one, is not working. And in an attempt to address the critiques, the latest 2020 code shifted its focus to advancing an ESG agenda and contains a much broader concept of stewardship and of the techniques to be deployed to further stewardship than does the previous code. So it's not anymore about engagement, but it's much broader. So consider now a company with a dual class structure. In such a company, even if institutional investors own a majority of shares, they will not have the collective legal power to steward the controlling founder. Therefore, even if we assume that the 2020 Stewardship Code succeeds in transforming institutional investors into actively engaged stewards, these investors will not have the collective voting power to steward listed companies with dual class shares. So in such companies, institutional investors will be more akin to absentee tenants rather than absentee landlords that Lord Minus grumbled about in his review of the pension fund industry in 2001. Of course, one could argue that there is no need for an institutional investor to act as a steward when there is a founder with a controlling voting power, because this founder will have the legal rights and, of course, the incentives to steward the company. Of course, here previous literature highlights that there is space for private benefits of control and agency costs. So the threat that a dual class structure poses on shareholder democracy explains why there is a clear institutional investor in the state for dual class stock for decades now, not only in the UK, but also abroad. I don't have the time to go into the details of that, but at the same time, it is interesting to note that in practice, institutional investors have supported several IPOs with dual class structures, especially in the US, which shows that sophisticated investors often rely on private ordering. And I think we have Bernie with us together, who wrote a very interesting article about private ordering. So in practice, institutional investors are willing to invest in high-performing companies. Snap in 2017 is a key example of that. Even when there are ordinary shares with no voting rights, and even when there are no sunset provisions. So this is an important consideration for the UK, given that the overwhelming majority of shares are owned by overseas investors, which are already assessing the wealth maximizing efficiency of IPOs with dual class shares elsewhere. Turning now to the specifics of the Hill review, it is clear that many institutional investors have already expressed their concerns in the responses to the review and have argued that the introduction of dual class shares in combination with a dilution of the 25% free float requirement would effectively shield the management from shareholder pressure and allow them to run the company without any control. One of the key arguments presented by the investor, which is also supported by the empirical literature, is that dual class share structures insulate the management from the disciplinary force of the market for corporate control. What has not really been discussed is that such a structure also insulates the founder from the market for corporate influence. And this is the discipline and the impact associated with engagement and voting by minority shareholders. In other words, dual class shares leave very little space for the exercise of voice, and the introduction of the proposed regime seems to undermine the stewardship code, as the dilution of voting power severely weakens the ability of institutional investors to act as meaningful stewards. And this is why the International Corporate Governance Network, I think they have publicly described the simultaneous move towards stewardship and dual class share as regulatory schizophrenia. So the question now is it really a schizophrenic movement? We have already listened to some key arguments in favor of the regime from previous speakers, and I'd like to bring another perspective here. Let's assume for a moment that we all agree on the merits of shareholder stewardship, which of course is itself very contested as well. But let's assume that we all agree. Is it possible for an institutional investor to steward the founder in a company with a dual class structure? So while in companies with one share, one vote structures, the direct target of stewardship is corporate mismanagement, in companies with increased concentration of equity ownership, shareholder stewardship could potentially play the role of monitoring the controlling founder and reducing tunneling. So although the founder, rather than management, should be the key target of shareholder stewardship where a company has a dual class share, there is surprisingly no stewardship code, which has explicitly adopted this conception of stewardship, not even in jurisdictions like Singapore or Hong Kong, which have dual class shares and a stewardship code. So here there is one possibility for the future. So perhaps the FRC should reconsider its reporting requirements under the 2020 stewardship code and asks from institutional investors to demonstrate engagement and stewardship with controlling founders. Of course, and the high corporate governance standards can permit this in association with detailed disclosure by the issuer. Of course, a counter argument here is that stewardship has not proven to be entirely successful in companies with one share, one vote structures. So how are we expecting from investors to act as stewards in companies with dual class structures? I do not have the time to go deeper into this, and probably Janice is going to bring the perspective of pension trustees. But one point I would like to make, I think we also need to distinguish between the stage before the IPO and after the IPO. Before the IPO, I think that one could argue that a sophisticated investor is unlikely to shoot itself in the foot and invest in an IPO where he doubts about the abilities of the founders. So at this stage, the private benefits of control are quite low. And of course, a counter argument here is that even if institutional investors avoid those IPOs, permitting dual class firms on the premium tier could give them an implicit regulatory seal of approval that could attract unsuspecting retail investors. Plus, here there is the issue with index funds, but one could say that retail investors constitute a nominal presence in the UK public market, so maybe that's not number one problem. I think, however, that the risks are higher after the IPO. Consider, for instance, the effectiveness of independent directors or the effectiveness of corporate governance standards in controlling shareholder firms. And here is where I think that the inclusion of the safeguarding measures proposed by the Hill Review are really important to find a compromise position between an outright prohibition of dual class share structures and allowing issuers freely to adopt a perpetual dual class structure. We can debate of each of those measures, and one should be aware of the very low market acceptance observed in Hong Kong and Singapore after the introduction of similar safeguards. Being conscious of the time, I'd only like to take 1 minute to highlight what I think as a problematic aspect in relation to one of these safeguards from the perspective of stewardship. And this is the proposed maximum voting differential of 20-1. From the perspective of stewardship, this is likely to undermine the monitoring of controllers from institutional investors, because the founder could control 50% of the voting power with only 4.8% of the shares. In my view, the proposed ratio is too high and creates huge divergence between control and ownership. And there is empirical evidence that the wider the divergence, the lower the associated firm valuation. So again, from the perspective of stewardship, a lower ratio, perhaps 10-1, which still gives to the founder voting control with a stake, I think, of 9.1%, is capable of constraining potential agency problems and perhaps better aligning the interests of the minority shareholders and the founders. I'm going to stop here, but we will certainly have the opportunity to discuss the different aspects in the second part of the session. Thank you.
Great. Thanks so much, Dionysia. I'll introduce our penultimate speaker, Janice Turner. So Janice is the founding co-chair of the Association of Member Nominated Trustees. The AMNT is a not-for-profit organisation supporting member-nominated trustees and representatives of UK-based pension schemes, ensuring that the voices of pension scheme members are heard in industry and government. Janice has been named as one of the most influential people in the pensions industry, and she's also a member of the Financial Reporting Council's Investor Advisory Group. Janice, we're really delighted to welcome you and hear your perspective on this.
Well, thank you very much indeed, and thank you for your very kind invitation for me to speak today. The question I want to start with is in whose interests is this change? Because it's clear, we've heard how it is in the interests of the companies that are interested in holding this type of share structure. But how is it in the interest of the ultimate asset owner, the pension schemes that invest in the premium listed companies? And how is this in the interest of the ultimate beneficiaries, the pensioners who are dependent on a return on their investment for their retirement? A poor return on investment for many people is the difference between living securely or being unable to afford to heat their home in winter. So this is an important issue. What I'm talking about here is risk management, and risk management in relation to the environmental, social and governance, ESG, issues concerning the companies that pension schemes invest in has been the subject of increasing regulatory pressure on pension schemes in the last few years. So I'd like to set this in the context of the requirements that trustees now have with regard to stewardship and the difficulties that they are having in fulfilling them. Pension scheme trustees are required to specify their policies in relation to financially material considerations, including those relating to ESG considerations, such as climate change, over the appropriate time horizon of their investments. They must also set out their policy in relation to the exercise of the rights, including voting rights, attaching to the investments and undertaking engagement activities in respect of the investments. And they've got to state in a published document how they have put this into practice, including holding their fund managers to account for actions taken on their behalf. So the direction of travel faced by trustees is towards holding their own voting policy that sets out how they believe companies should be governed and setting out how the votes associated with their assets may be cast when a company fails to govern itself in accordance with the shareholders' policies and does not respond to engagement on the matter of concern. So I'm sure you can appreciate our view that being able to set our own voting policy and having it implemented by fund managers is a really important protection for our assets. Trustees are also under pressure from government. A report on executive pay by the BEIS Select Committee some time ago stated it is up to asset owners to give any direction on the stance to be taken by asset managers on corporate governance issues, including executive pay, and to hold them to account. Unfortunately, it's not that simple. It was excessive executive pay back in the shareholder spring of 2012 that drove the AMNT to develop red line voting, which was the UK's first publicly available off-the-shelf voting policy for pension scheme trustees that encompassed ESG issues. Trustees who had wanted to join in the opposition to executive pay had been told that because they invest in pooled funds, they couldn't do so. And it wasn't worth the fund managers while organising split voting, even if they wanted to, as there was too little demand from the asset owners. So the AMNT developed this voting policy following substantial consultation with the investment community, basing the policy on UK or globally endorsed principles, including the UN Global Compact. AMNT envisaged that pension schemes could adopt the policies and require their fund managers to operate them on a comply or explain basis. The fund managers were free to vote contrary to the red line policies, but if they did, they were required to explain why. So it was a shock to asset owners, therefore, that when those in pooled funds began adopting the red lines, major fund managers refused to accept their clients' policies. Fund managers' arguments have been many and varied, but our recent report, Bringing Shareholder Voting into the 21st Century, concluded that none was insurmountable. If the government and UK regulators are expecting asset owners to raise their game with respect to the development of robust stewardship policies and taking into account beneficiaries' views in their approach, how can we take these views into account if we can't even get fund managers to take our own views into account? So at a time when pension scheme trustees in pooled funds, in which roughly half the assets under management in the UK are invested, are being denied the right to have their voting policy respected even on a comply or explain basis, this proposal for dual class shares, some may consider to be the last straw. How are we expected to hold a company to account for its governance when in practice we have no influence at all? It would seem that this proposal could be summed up as these companies with dual class shares wanting our money, but without the appropriate accountability. There is the suggestion that the dual class shareholding could be, dual class share voting could be limited to, for example, ensuring that directors continuing their jobs and that the company can't be taken over. But this in effect gives directors free rein to ignore investors even more than the asset owners were being ignored before. One response to this might be for investors and asset managers to no longer bother to engage with investee companies over matters of concern, and instead to just pull their investment if they disagree with governance issues. But that goes against what is considered to be best practice. What investors are supposed to be doing is engaging with companies and discussing these issues in the hope that they will be resolved. But even this doesn't square it, because the advantage of premium listing, as earlier speakers have pointed out, is that there are many funds out there that are index funds. So asset owners investing in these funds will invest in these companies whether they want to or not. I'm aware of suggestions that perhaps changes could be made so that index funds can exclude them. But isn't this starting to look like using a sledgehammer to crack a nut? Do we really need that nut that badly? And there's also the suggestion of a 5-year sunset clause, and I'm sure that the lobbying would have started to extend this from the minute that it was introduced. So in this context, where asset owners are still fighting to have fund managers even pay attention to their voting policy, making it even more difficult to have influence on a company is to travel in the wrong direction. Elsewhere in the Hill review, the report does come near to the issues that I've raised here. One of its recommendations is to consider how technology can be used to improve retail investor involvement in corporate actions and their undertaking of an appropriate stewardship role. It points out that the transition from defined benefit to defined contribution pension arrangements is putting the retail investor at the heart of decisions associated with their future, but also means they're carrying more of the investment risk, and as such should be considered in any redrawing of the listing rules landscape. It adds that the cost, speed, and efficiency benefits from introduction of technology have yet to be felt by retail investors, but it has the potential to bring a greater level of transparency, resilience, as well as democratization of access to parts of the capital markets for all investors. It recommends that as BEIS takes forward the work on intermediated securities, it should consider the most efficient way of using technology to improve the position of retail investors seeking to empower future generations of savers. What the UK listing review team has not appreciated is the reality that the issues faced by retail investors in being unable to use their votes is also the reality of most pension schemes that invest in pooled funds. Another of the review's recommendations is for the Treasury to consider and act on industry concerns in relation to the wider financial ecosystem concerning unlocking pension investment. So it makes it clearer than ever about how they would like pension scheme investment in listed companies. Well, if they want more pension scheme investment, they really need to ensure that we get the stewardship and voting rights that should come with that investment. But so far, in the main, particularly with smaller pension schemes, we have not. So I would conclude that at a time when pension schemes are fighting for their right to direct their asset owner votes, even on a comply or explain basis, now is not the time to enable companies to become premium listed, but reducing still further the accountability to the asset owners that should be an unquestioned prerequisite for investment. And if this does go ahead, then returning stewardship and voting to the asset owners has to be part and parcel of that. Thank you.
Thanks so much, Janice. Last but certainly not least, I'd like to introduce Dr. Ewan McGaughey. Ewan is a reader at the School of Law, King's College London, and a research associate at the CBR in Cambridge. His core research interests are economic and social rights, particularly in the governance of enterprises. So I'll hand it over to Ewan for our last presentation.
Thank you so much, Anna, for chairing. Thank you to all the speakers who have already gone. I think it's a really fantastic exchange, and I'm very much looking forward to the contributions from the audience and all participants very soon. So should dual class shares be premium listed? I want to offer a different perspective to what's already been said, and the main argument that I'd like to put forward is that we should be moving to a system where more people can vote and participate in corporate governance, not fewer. That's really important to solve some of the really big challenges that are facing corporate governance in the 21st century, escalating inequality and climate damage probably being the biggest two. So I think when we look at the empirical literature, it's fairly clear to see that there's not sort of decisive evidence one way or another, empirical evidence about whether dual class share structures are good. Usually that empirical data or the studies look at returns to shareholders and evaluate whether dual class shares are good on that basis. So it's fairly clear that there's no decisive evidence one way or another about dual class share structures. But I want to put it to you that when we look at the history, and when we look at the evidence of not effects on social, shareholder returns, but on social effects, the evidence is much more clear. And so I've got three main points. The first is that history shows the dangers of dual class share structures or multiple voting shares or non-voting shares, any departure really from the one share, one vote norm. The second main point is that when we have a purposive interpretation of UK company law, and this, I think, is the difference of my perspective that I'm bringing to the debate, is that when we look at company law, dual class share structures can't stop a majority of members from removing the board of directors under the Companies Act, section 168. And that's very clear, I think, from a purposive interpretation of company law. So it actually doesn't matter what we do with the listing rules. And the third main point is that I think there's little evidence of innovation, and actually there's a lot of evidence of a great deal of harm in companies that have had dual class share structures. So I'll get to those at the end. So first of all, the first main point is about the history. So when we look back in time in the UK, we haven't really seen dual class share structures being widespread since the days of the East India Company or in the sort of dark times in the 19th century. They were, however, growing as a major feature. Dual class share structures became a major feature of US corporate law, particularly in the 1920s in the run-up to the Wall Street crash. And this began or exploded particularly with a big issue of non-voting shares by the Dodge Motor Company in 1925. So this triggered a big social response by the investment community, by the shareholders all around America. And but the slide into taking voting rights away from shareholders was one of the big reasons identified by the Great Law and Economics Partnership, Burley and Means, as being one of the causes of corporate unaccountability in the lead up to the Wall Street crash. It was changed in the New Deal so that by law, a New York Stock Exchange practice of discouraging dual class shares or non-voting shares in particular, or multiple voting shares, was put into Securities and Exchange Commission practice, and that lasted up until the 1980s with a change of regulation by the Reagan government. It was even worse in Germany before, the Great Depression and the Wall Street crash. In the 1920s in Germany, according to one study in 1925, around 1/40 of capital, total capital in German companies, accounted for 38.2% of all the voting rights. So German unaccountability in the corporate world was extreme, even more extreme than in the United States. And of course, the large corporations, largely unaccountable, boards of directors largely unaccountable to any of their investors, were working with banks who also were taking more and more voting rights. And these were the very people, and I think this is no exaggeration to say, these were the very people who were backing the fascist government in the beginning of the 1930s. So all of this experience is what led in the UK after the Second World War to the Cohen Report in 1945 to look at director accountability. In 1947, we passed the Companies Act, which introduced the rule that we have now in Section 168 that says a majority of shareholders, or with one share, one vote, or a majority of members and voting rights can dismiss the board regardless of anything in the company's articles. And it was very important that at that point in the House of Commons, Sir Stafford Cripps, who introduced the legislation, said the following. And this is effectively quoting from Burley and Means. I'll just read it out. He said, with the great growth in the size of companies, the old relationship, which really grew out of the idea of partnership, where individual owners were closely concerned themselves with management, had largely disappeared in the modern company structure. So that's the problem they needed to fix. The growth of groups or chains of companies which make the true economic entity rather than the company itself, where we get a whole complex of companies operating together, that factor has further divorced management from ownership. So that was the language of the separation of ownership control seen in Burley and Means. And the main reason, making sure that company directors were accountable for introducing the legislation that we still have today, ensuring that investors are not disenfranchised. When we look at the case law as well, the House of Lords in 1970 addressed this issue and allowed dual class share structures, triple voting in a case called Bushel and Faith, so that in a very, very small company with 3 people, the directors couldn't be removed. But that's very, very different from the purpose of the legislation, which was targeting big companies, like those that would be in the premium listing section, from having any kind of mechanism that would frustrate the right of directors or the right of shareholders or investors to remove directors by a simple majority. So now if we look at today, I think even if we introduced dual class share structure or allowed them on the premium listing section, it still wouldn't be possible for the directors to not be removed by a majority. And that's really important because, when we look at companies like Deliveroo and we see the founder, Will Shu, holding 50% of the votes with just 6% of the stock, it's very clear that there's not going to be an accountable governance structure resulting from this. I think Anne was absolutely right to mention the employment practices of Deliveroo, before the London's worst ever IPO. Deliveroo drivers or cyclists rather are often being paid as little as £2 an hour. A third of them, one study has shown, it sees the drivers or the cyclists earning below a minimum wage. So that's a third. And so this is really not the sort of structure that we should see in employment practices that we should see from an accountable company. And then there's the argument that we want to encourage innovation. So we have companies like Facebook or Twitter or Google with dual class share structures. I mean, really, these are advertising companies as opposed to the sort of reputation of big tech. And if we just focus on Facebook, with complete unaccountability of Mark Zuckerberg, we see awful social effects, not least the national terrorist attack on the US Capitol, with support for the extremist politics represented by Donald Trump being drummed up through Facebook. We have televised mass shootings like at the mosque in New Zealand, and the encouragement of genocide in Myanmar. The social effects are very, very severe when we have companies that are unaccountable. Alibaba is another good example. It's just been fined the biggest fine ever in Chinese competition law history for anti-competitive or monopolistic practices. So actually the best thing that we can do is empower people more, much like Janice was saying. We do definitely have a problem with short-termism. I think that the Kalifa review and the Hill review have raised really important points about short-termism and founders wanting to have their positions protected. But the best way that we do that is that we change the asset management industry by making sure that BlackRock, State Street, Vanguard, the big asset managers that are voting on other people's money, are accountable to the real investors. So that's the best thing that we can do: enfranchise more, not fewer people. Thanks very much for listening.
Thank you, Ewan. So that concludes our formal presentations for the evening. And I'd just like to say thank you so much to all of our speakers. It's been absolutely fascinating whirlwind through so many different interesting perspectives, more perspectives than I'd anticipated on this issue. So we'll now open up the floor to questions or comments from our audience. So please feel free to raise your hands using the raise hand feature on Zoom, or put your questions in the chat. We'd love to hear your thoughts or questions on this.
Does everyone know how to raise their hands? You go to reactions and then you click that, and then I think there's just a raise hand function.
Oh, do you have a question, Bernie? Feel free to just go ahead. We don't need to see your hand.
Oh, okay, great. Thank you. I was really perplexed. All the presentations were fabulous. Thank you very much. One thing I just wanted to kind of introduce is, and Anna knows about this and Luca does too, is that I recently read a really fabulous paper on dual class shares, and it's by Dhruv Agarwal, Ofer Eldar, Yoel Hachberg, and Lubomir Liktov. And it's called The Rise of Dual Class Stock IPOs. And I'm not an empiricist, but I read this article, and what it did was it really started cutting or slicing the data so that it gets beyond the surface. And when you see studies where they say the premium expires after 5 years or 7 years or whatever, to me that work, and one work is by like Rob Jackson when he was with the SEC, and he said something like between 5 and 7 years the premium for IPOs disappear. Well, if you look at this article, you see that kind of analysis kind of is really just hits the surface, because it does not try to break up the dual class shares into different categories. And from this article by The Rise of Dual Class Stock IPOs, you see that in the United States anyways, since I think 1994, less than half of dual class share IPOs have been founder controlled. There's been other reasons why you've had dual class shares, okay? And so if you were kind of to break up the data, only looking at founders, and then you might see, I really have a strong feeling you're going to see is that the analysis will show that the time period is much more extended than 5 to 7 years. Okay, so that goes into what kind of time-based sunset is optimal. Okay, I guess that's my major point about sunsets, but I think it's really important to, their work really kind of like, it kind of opens things up. And so the analysis, I think, will be a lot more precise going forward. And I'll put down the name of the article in the chat. That's it.
Would anyone from the panel like to comment on this? I'll just sort of open the floor to whoever would like to respond. No, any comments? No. Okay, Catherine.
Okay, thanks, Anna. Thanks very much for the really insightful comments. My question was basically, it seems like dual class shares. Can you hear me? Yeah, okay. It seems like dual class shares is a deviation from shareholder value maximization in governance. And I mean, there's a lot of debate about this, and mostly, for example, for banks and financial institutions, it's being sort of justified because we have systemic stability. I'm wondering to what extent innovation is as a strong of a sort of justification for deviation of shareholder value maximization, and if there is some support for that we see more innovation, or whether this is just sort of a type of race of the bottom type of thing where we want to attract people to list on our venues, and therefore we want to make it as attractive as possible to those who come to our venues, basically the managers who will decide on where to list. So I'm just wondering what are the sort of advantages and whether there is some support for that.
I'm happy to start. I'm looking at some statistics here from the US. So in June 2017, Goldman Sachs performed an analysis of an index of technology companies with multi-class structures compared to returns from the broader indices. So this was looking at the period from 2004. Companies with a multi-class structure returned a growth of 348.5%, the NASDAQ Composite 221.4%, and the Russell 2000 146.2%, compared to the S&P 500, which was 118.7%, looking at a straight average basis. So, that's just one statistic. There are a number from the US that show companies with multi-class structures having outperformed the broader index. So there's certainly some empirical evidence out there looking at the performance of these companies, certainly in the US.
If I may add something, Bernie has a paper on this that shows that actually the decision by S&P to exclude companies with dual class shares from indexes has hurt investors because their return have been lower than if these shares had been included in the indexes.
Okay, thank you very much.
Susan? I have a question, or I have a comment. I can't find that raise hand thing. Anna, can I speak? Is okay, or? You're on mute.
Sorry, I realized I was muted. Yes, go ahead, Bernie, and then we'll go to Peter after you.
A while back, when I was starting to write papers, I had Henry Mann, and I'm bragging because Henry Mann to me is really great. He actually started commenting on my papers. Okay, that was quite a while ago. And well, actually, maybe not that long ago. But anyways, I would write a paper up and he would say, okay, wonderful paper, except you missed what most authors miss when they write a paper. And that is, you forgot to talk about the markets. And I think that's really something that, needs to be focused on. What does the market really want versus what, and I know I'm probably getting a lot of criticism here, but what does the market want versus what the regulator wants, okay? And when I say that, the example is, actually just came up recently, is this Snap. Snap issued the non-voting shares. It got people all upset. It led to the elimination of new dual class shares in the S&P 500, which I thought was a crazy thing. Empirically, Vincent Deliard and I found that it was a crazy thing, and other people found that too, I guess. But the thing is, Snap has just recently announced that they're going to a net zero carbon emissions policy. And okay, they don't have any investor stewards to tell them what to do. And I got a feeling they're probably going to do a bang up job on this, just my impression. And I might be wrong. But why did they do it? Well, because the markets told them that this was going to be a good thing for them to do. And so they are going to implement this policy. And so I think you're going to see a lot of companies, whether they have investor stewardship or not, they're going to move to this because they know that their customers are going to want them to be doing this. And so they're customers. So just a point that, it's a big picture, and, markets do really still matter. And, that should really be taken into consideration.
Thanks, Bernie, for that comment. Does anyone want to respond to that, or should I move on to the next question? Any thoughts?
Anna, can I also, I cannot find the raised hand, sorry. Just a very short comment. I agree with Bernie. I think we also need to consider it's all about the it's like a bargaining power. Who has the bargaining power? If the founder has the bargaining power and the market is convinced about the value maximization effect of having a founder with dual class shares, then definitely you're going to have no sunsets. On the other hand, if the founder does not have such a huge bargaining power and the institutional investors have the bargaining power, then you're going to have sunsets. I think the question here is if there is any, what is the role of the regulation? If the regulator should play a role on that. Because otherwise we can just leave it to the market and private ordering. So I think that the Hill review tries to bring this together, and trying to create a regulatory picture that can balance all the interests. So that's my comment to what has been said.
Thanks, Dionysia. Does anyone else have any thoughts they'd like to add?
Perhaps I'll just add, do we want to have a corporate governance system where bargaining power shapes the outcomes of company constitutions? It seems to me that we can have principles that override the power that major investors or major directors have, and that's a very good thing. When we look at, often in this discussion, Apple, Amazon, and Microsoft are brought up. They are big tech companies, if you like, and that they have never had dual class share structures, and it's entirely possible to have sort of dominant entrepreneurial founders having a great deal of influence. But if they ask for public money from the public markets, then surely people should be able to get a vote.
And if I can come in as well, actually, briefly, just to follow on from that, I'm really glad that there's more and more companies that are adopting net zero policies. But we carried out a study, the AMNT carried out a study comparing our own voting policy that quite a lot of pension schemes had adopted with those of more than 40 fund managers. We wanted to look at climate change, gender diversity, ethnic diversity, and excessive pay. And what we wanted to see was whether the policies that we'd adopted were reflected in some of the big fund managers' policies themselves. And what we found was, actually, they're not. On climate change, for example, and I'm going back a couple of years here in the study, but at the time of the study, of those that publicly disclosed a voting policy, over half of the fund managers at the time did not have a climate change related voting policy or guideline in their voting policy. On gender diversity, of the fund managers that publicly disclosed a voting policy, because at the time not all of them did, over 30% of fund managers made no reference to gender diversity on boards. of ethnic diversity, which of course you'll know that there's been subject to a lot of challenge over the last few years, but particularly more pressure following Black Lives Matter. On ethnic diversity of those that publicly disclosed a voting policy, nearly 3/4 of fund managers made no specific mention of ethnicity with regard to board diversity. And on excessive pay, few fund managers had a voting guideline on tackling excessive total remuneration in some form. So that goes to show that what is missing in this equation is the right of the ultimate asset owners, the pension schemes, to be able to have their own policy, which is different from fund managers, and have that respected and acted on, even if it's on a comply or explain basis. That is what is missing so far, and that's what needs to be rectified.
Thanks. So I think we'll move now to Peter.
Thanks, Anna. Peter Swaby from the Chartered Governance Institute. I'd start off, if I may, by agreeing with what Bernard was saying. I think an important part of this, which perhaps we sometimes miss, is around what the market is looking for. And I think we have to remember that there are some fund managers and some underlying owners who are keenly interested in being stakeholders, who are keenly interested in stewardship, and who spend a lot of time and effort sort of making sure that their stewardship activity goes well. There are other investors who are purely and simply that. They've taken a punt on a company on the basis that they think that share price is going to rise. To a degree, if I were being slightly tongue-in-cheek, I could say it's a little bit like putting something on something you've got a tip on the 230 at Haydock. It's purely a investment gamble, if you like. They think the price is going to go up. So I think there are two different types of market activity there. And I think there's a degree to which some of the regulation we're talking about is playing to the first, but then sort of forgetting that there is the second. I suppose my question for the panel, if I may, is if this is an issue, how best can we address it? The feedback that I constantly get from companies and from investors is that the issue primarily is around where an investor cannot divest because the dual class stock, for example, Facebook, is in an index, and that investor tracks the index, and therefore they can't not be in that security. They haven't got the ability to disinvest. And fine, I see that as a problem, but my question is whether it is better to say, okay, fine, so they shouldn't be allowed to be listed on the market in the first place, or whether it is better to say, okay, fine, they can be listed on the market, but as a standard rather than premium, and they shouldn't be included in the indexes? Or is it better to put the onus on the fund managers and say you need to make it clear to your clients that there are going to be times where if they're invested in an index, they are going to have some of these firms where they have no effective sort of stewardship control. And the alternative is that you give us a mandate that says we don't have to follow the index if there is a dual class stock involved. What do the panel think is the best solution to the challenge that we've got here? Sorry, that was a long and rambly question.
Who would like to start us off with a response?
I can make a start. It seems, Peter, I mean, that's a really good point, but it seems to me that some of those options aren't, I mean, they could, but both could be done. I mean, you could have the onus on fund managers to have a more detailed approach to stewardship, and also developing indexes which exclude certain companies. I mean, you can have an index minus I mean, I think indexes minus fossil fuel companies is something that we are going to have to see very, very soon. That you could also have indexes minus dual class companies, if that is an option that a lot of investors wanted, as well as the regulatory problem. So, you know, if we had to have a change of regulation, it seems to me, you know, one of the themes that runs throughout this debate is, well, you know, whatever we change in the regulation, how are the asset managers going to react? But there could just, you know, not be a change in the regulation.
Yeah, or you take the regulation under more consistent review to make sure you can evolve it over time, which I think, you know, is another core tenet of the Hill review, is to say you shouldn't think of regulation as a static point, and you can always move forward with these things and explore some of this stuff and look, if it doesn't work, it doesn't work, and you can move back. And there, you know, it's just one of the risks you have in the market. But if you just don't change anything, you're going to get superseded by the rest of the global market. The reality is the UK is not a bubble. You know, you can't operate just on its own standing. You know, there are plenty of other market forces and factors out there, which means we do have to be cognizant of that. You know, it's great to have absolutely the perfect view, but if there's nothing to govern, you've governed as failed. So, you know, it's there is a balancing point there. And I think there's some other horror. I mean, we're throwing stats around today, and I always say stats, you know, lies, damn lies, and statistics. But you know, there is the other stat that says there's more indices than there are shares in the world. So you know, the potential to find indices that actually filter the way to find investors. But the challenge on that is actually then how do you match investors with those indices and identify them correctly. But yeah, I think there is a point of evolution here that we need to work with. And that ability to continue to evolve and tweak is an important part of this.
It's worth also just mentioning that it's actually very new that we've got a listing rule that says that dual class share structures can't be premium listed. I mean, it was middle of the last decade. So I mean, funnily enough, regulation has actually just evolved in this direction. Before there was not any explicit rule.
Yeah, we've had plenty of ins and outs, and we've been burnt by changes in regulation. I mean, we've had, you know, the joys of lots of overseas extraction industries coming onto the UK market and plenty of challenges there. We've had, you know, other high growth segment plans and reversals on that side. So, you know, this has continued to evolve over time historically. And as I say, it's still sort of finding the right point on that.
Another point I would like, sorry.
No, please.
Thank you, Luca. Another point I would like to add is that I agree with Chris and at the same time with Ewan, because it's, I mean, we should look at that holistically. It's not just the dual class shares, you know, ban or allow them. It's much more the regulatory ecology. For instance, if you want to give more voice to asset owners, we need to start thinking about the stewardship code itself, or other ways, you know, other mandatory rules that, and there have been some recent changes about the inclusion or exclusion from the index. I would rather say that that's probably a premature thing right now, because I mean, in my view, the Hill review includes so many safeguards right now, which from, you know, from a stewardship perspective, there is some protection. So I would say the problem is perhaps at another level. The problem is between asset managers, asset owners, and beneficiaries rather than at the safeguards per se. But of course, it's revolutionary. And I also have some conservations about some of those safeguards, as I explained before.
Yeah, yeah. For a purely practical point as well, I don't know how many people have ever turned up to shareholder votes, but believe me, there's some pretty empty rooms when you go through some of these things. And an awful lot of transactions and things that businesses get towards never get to a shareholder vote, because, you know, there will be shareholders in the background that will already be exerting their influence well below, you know, any sort of minority or driver on that. You know, I've plenty of times where I've seen businesses look to do something and they've tested it and they've just walked away even before they've given it to a broader vote.
You want lots of people there, Chris. Announce that there's a free bar.
It's tea and biscuits these days. It's very dull.
May I?
Yes, please, Luca.
Yeah, I will make an extremely naive comment here, but I really can't help asking what are the third-party effects that people worry about. I mean, these are transactions between adults who consent to investing in an individual company, which may have some characteristics which they may or may not like. If they like it less, the price will be lower. If they, in the aggregate, they like it less. And I think that for every Zuckerberg that you can think of at the top of a dual class share company who misbehaves, you can think of the Anthony Haywards, who was the CEO of BP when BP got involved in the Deepwater Horizon disaster, or any other bad guys out there who happen to be at the helm of dispersed ownership company and do something bad. I don't think there's any correlation, systematic correlation between doing bad stuff and being at the helm of a dual class share company. Actually, if anything, we perhaps many in the audience don't even remember Anthony Hayward. I guess Zuckerberg will be remembered for decades to come, whatever he does, even if he doesn't misbehave anymore than he's doing. And the reason is that everyone knows that he is to be blamed for anything that goes that happens at Facebook, which means that some degree of accountability is there. It won't be legal accountability. It won't be the shareholders are removing him from the general meeting, from the board, but definitely he is facing some pressure because his name is everywhere. And of course, I'm not defending Zuckerberg. I'm just saying that we can find bad guys in all kinds of companies, unfortunately.
Yeah.
And
sorry.
No, that's all actually. Yeah. So no, I just wanted to. So that's also an implicit answer to Peter, basically, who had a specific question. But I think I by saying what I said, I think I gave him an answer.
Yeah, I was going to say, I think, funnily enough, this also sort of touches on some of the other elements that we considered as part of the Hill review around the sort of information asymmetry investors have at this stage, and that ability to make a decision on, do you want to give up some control over a period of time versus the longer term outlooks of a business and the comparative performance you might get. You know, the fact that we have this massive restrictions on the ability to provide forward guidance at the point of an IPO means that you're playing with Chinese whispers between analysts considering the potential performance of a business, where it might get to, and you're making an investment decision and weighing it up on that. So, you know, you used to start on the point of, if you've got perfect information, you can make that decision. But, you know, even in a very strong operating market, you absolutely don't have that perfect information. I'd be well and truly out of a job if we had that perfect information out there for people to make a decision on. So I do think there are sort of some broader challenges on just that simple point that says, well, everyone understands the risks that they're getting into and the outlook, and they can make a decision on it, because actually that's a harder question to solve.
If I could just comment on one observation, I'm sure it's, I hardly need to say this, I'm sure people are already familiar with this idea, but I think where the whole indexing issue comes in is that it's one thing for an investor to invest in a company and then think better of it and disinvest. But if you invest in an index fund, then you invest in the fund or you don't invest in the fund, and you don't have a choice about which companies you might care to invest in. If you don't like it, then you have to find a different index fund, but you can't simply exclude a company. And consequently, when you are invested in an index fund, the only choice that the investors have is engagement, for the very reason that they don't have the choice of exiting. The whole point of an index fund is that it's mirroring the index. And consequently, if there's no way to even engage in a meaningful way with the company, that's why there is an issue. And I can see that, you know, it's not necessarily the case that companies with dual class shares are likely to be better or worse than the other companies. But the point is that there needs to be an appropriate level of accountability in exchange for the investment that they're getting, and that's why there's an issue with the placement of these companies in indexes.
Thanks, everyone. I have one quick question from someone in the chat, and then we'll move to Min Yan, who's raised his hand there. So we have a question from William Charnley in the chat asking, do the panel think that there's any real difference between a company that has a dominant founder shareholder, so say a founder with 75% of the shares, that can be in an index versus one where the founder shareholder has 75% of the votes, but not the economics to match that, and thus couldn't be in an index? So sort of what's the difference between economic shareholdings versus the voting power? Any thoughts from the panel on that?
If no one speaks, of course there is a difference. There is much greater alignment of interest for the company with the dominant shareholder which has 75% of the cash flow rights as well as the voting rights. That's for sure, no doubt about that. So the minority shareholders have much less to fear in case of one share, one vote in terms of minority shareholder expropriation. However, they may also be faced with the risk that the company is unable to grow, especially externally, when there are good opportunities to, for example, buy another company. If you have a controlling shareholder who wants to retain full control, they may just decide not to make an acquisition that may be good for all shareholders because they don't want to dilute their holding. So there is a trade-off anyhow that shareholders face, and every company is different from the other. And so in some companies, it may be good to retain this. In some others, it will not be good. And the important thing I think is that this choice takes place at the IPO stage and not later on. I think this is a discussion that is not going on in the UK, luckily. There seems to be no doubt that companies that are already listed shouldn't be able to switch to dual class voting structures, unlike in other jurisdictions. That's good, but that is I think that is the real risk here, that you are in a company with a 75% shareholders or 51, that at some point changes into a company with dual class shares with the dominant shareholder that dilutes its cash flow rights and retains high voting power, because you haven't been, as a minority shareholder, to say the least, you haven't been compensated for that change in the risks that you are facing as a minority shareholder. Thank you.
Thank you, Luca. So now we'll go to Min.
Hi. First of all, thanks for the very insightful and interesting discussion and panel speech. I'm a big fan of dual class shares, and I think that it can help to solve the founder's dilemma, because founders, they wish to retain the control when raising capital. Regarding to the potential increased governance risks, I think the safeguards would have to at least to mitigate most of them. So for example, the enhanced voting rights. So for some fundamental issues, the shareholders without the multiple voting rights can also vote on a one share, one vote basis. I'm even in the view that we should not have very strict safeguarding measures, because that may discourage companies to adopt the dual class share structure. So for example, in Hong Kong, Singapore, or including the mainland China, which adopts the new listing rules allowing the dual class listing, by having strict safeguarding measures, but the result is that very few companies choose to list with the dual class shares. However, I have two questions for our panels, because from a historical perspective, in the UK, we know that the demise of the dual class shares is not because of regulation, but because of a choice. So because shareholders, mainly the institutional shareholders, they didn't like such share structures, and it's not because of regulation. And that's why in the end of last century, there are really no dual class company in the London Stock Exchange. So even the Hill review will be, the recommendations will be adopted and revised listing rules are adopted in the end. How can we ensure that there will be a change? Because if institutional shareholders in the UK, if they still resist such a share structure, there won't be many companies adopting such a share structures when they apply to list on the stock exchanges. That is my first question. And my second question is that it's an independent question, that because we know that the companies with controlling shareholders are allowed to list it on the primary segment of the main market. Why there are concerns that shareholders with the super voting power under the dual class share structure should not be allowed to list on the primary segment. In other words, I'm saying that if we can maintain the high corporate governance standard when allowing company with controlling shareholder to list on the primary segment, so what's the main concern that the company with dual class shares should not be allowed to list on the primary segment? So that's my two questions for the panel. Thanks.
I can kick off with some of that. So Min, I think on your first question about how do you get investors to engage on this or not accept dual class share structures, the point is you don't. But what you're trying to do here through this change in rules, certainly from the Hill Review consideration, is to give optionality to potential founders and people looking to raise capital within the UK market. So you won't necessarily get every company through on it, but you should be getting more options and giving people a chance to look at the UK market rather than just simply discounting it straight away because they can't immediately access it because there's a line in the sand which they're not allowed to cross. So part of this actually is helping to test the market. And undoubtedly, as you know, if there are changes that are made to the market, you will have people that test the boundaries on these share structures. And we'll see some that are absolutely hated by the market and some that are accepted by the market. And I'm sure you'll start to see market norms form as to where do you get in that challenge between the levels of corporate governance and, you know, founder control and a move to sort of a sort of an equilibrium on that status. But if you don't give the optionality on that, you've got no way of getting to that equilibrium in the first place. And I think it also comes back to Anne's sort of opening comments as well, is that if you've got people sat here today that are 4 or 5 years away from a listing and they're thinking about where do I take my next round of funding from in a Series B or a Series C, etc., are they thinking about a longer term exit route through the US or through the UK or through Amsterdam, etc.? And that does start to influence where you get your investors in those rounds and the step on from that. But, you know, very much, again, in the whole context of this, you know, we know there are massive wider challenges within the UK market to think about when you think about attracting growth companies, whether or not it's the state of our visa system, if it's the state of our tax situation, etc. There are way more considerations, and this is one small segment of it. And part of the challenge we've got here is, by picking it apart and looking at one element at a time, it's really hard to get that holistic view.
Can I add a very short point, if I may, Anna?
Yes, please, Dionysia.
Thank you. To the first question raised by Min, I think here we also need to understand who are the institutional investors, because you are saying institutional investors are not going to support a dual class structure. But my understanding is that asset managers are a bit different here from asset owners. And for instance, look at the Investment Management Association. Lately, they announced that they are quite supportive of the Hill review. So I think that there is some demand from asset managers, but the situation is different for asset owners, especially the small ones who are relying excessively on index funds. So I think we need to distinguish these two. And here, hopefully, the safeguards proposed by the Hill review will try to provide a kind of compromise. But the situation is a bit more complicated with asset owners, as we hear from Janice before.
If I could answer what I think about both your points. I mean, I think that you can say that actually regulation did play a very big role in the UK. It was obviously institutional investor choice, but I mean, in the 1960s, the Jenkin report looked at voteless shares and multiple voting shares and basically said, well, they're not a very good idea. We don't want to pass a law, but we're going to get the Board of Trade and London Stock Exchange to work together to make sure that these are discouraged. So there's a kind of joint regulation and choice story that you can tell. And on your second point, I mean, I think that, and perhaps I could tie this to the very interesting question that Luca posed, which is, what's the market failure? Or, why is it that, you've got a contract between adults that people shouldn't be able to do whatever they want? And I think that the answer is that the very big effects on third parties are very real, like the Wall Street crash. I mean, the reason that we had regulation coming from America in the 1920s is because the concentration of power, it was something that just continued and continued, and there's a tendency to do that, which I don't think is often accounted for in, sort of a standard analysis of, what the list of market failures is. The biggest market failure is inequality of bargaining power, which causes power to concentrate and unaccountability, and then you get things like the Great Depression in an extreme situation.
Thank you. Thank you.
Thanks. I think we're just about on time, so I'm sure we could keep discussing this for much longer. There's sort of lots of extra questions I personally had, but it was great to hear from our audience and the responses from our panel, who I'd like to just absolutely thank again. We're really grateful for your time this evening and for all your really interesting perspectives on this. And this is clearly going to be a continuing debate, sort of ever enduring, ever progressing, and there's clearly very strong perspectives from different stakeholders and interested parties, and certain compromises that have had to be made in the Hill Review and will continue to be made in the future. So I'd just like to thank our panel. I'll do the sort of traditional Zoom clap, but I realize it's beside the raised hand feature, so maybe people don't know where that is, but I'm sure everyone's very appreciative of these insights, and it's been a wonderful session.
Thanks very much, Anna.
Thanks so much, everyone.
Bye for now.
Bye.
Thank you for chairing.
Bye-bye.
Thank you all.
Thank you. Bye.
I'll just stay on for a minute. You're muted, Anna.